the only way to make money out of gold is if someone wants to pay you more in the future.
Hello and welcome back to the Personal Investor Podcast. I'm here with Tom Stevenson and we're going to be talking gold today, and in particular why some investors at least think you'd be mad to hold it in your portfolio. Tom, welcome along. Let me start with a quote, if I may. Who do you think said this about gold? I have no views as to where gold will be in the next 5 years, but the one thing I can tell you is it won't do anything between now and then except sit there and look at you. So, not the biggest fan of gold. Who said that?
No, slightly unfair because I know the answer to that. It is of course our friend Warren Buffett, one of the best known skeptics about gold as an investment.
Yeah, and we're going to talk and come on to why he said that. Actually, it's a bit more nuanced than that, but why some people don't think you should invest in gold. But before we do that, why don't you bring us up to speed, Tom, on gold this year? Because a lot has been happening. Why is the interest in it so high right now?
Well, one of the reasons why there's a lot of interest in gold is that it's going up very fast. I mean, it's been an exceptionally strong period for gold this year, but actually for a little bit longer than that. If you roll back 2.5 years to I guess the bottom of the market in October 2022, the gold price has actually doubled since then.
Yeah.
It was about $1,600 an ounce. Recently, last week, it touched just over $3,500 an ounce. So it's been a really strong period for gold investment.
Yeah, and what we've seen this year is gold performing this role that the advocates of gold always say it can do, which is to become a kind of haven, a store of value when investors have doubts on all sorts of other assets, and that's definitely been the case with the stock market at times this year. So that's been the gold's works basically.
Yeah, absolutely. I mean, it has been the best performing asset of all the sort of mainstream investment asset classes so far this year. I mean, the stock market we're just as we speak, we're at 100 days of the Trump presidency, and so I was actually looking at some of the numbers for that period, and gold is up more than 20% over that period. The stock market, the S&P 500, is down 8% over that period. And the bond market has sort of held its own, and some of the stock markets have done better than the US stock market. But broadly speaking, gold has been a really good place to be in that environment.
But it's not always the case, is it, that stock markets do badly, gold does well? There seems to be something, you need extra elements really for gold to take on this role, don't you? There needs to be sort of, I wouldn't say existential fears, but some sort of like big fear out there that everything's going to change in some way, that maybe, assumptions about the stock market or even the bond market are wrong. And that's when gold really shows its value. It's got this kind of like end of the world feel to it, isn't it, when gold does well?
Yeah, it does. And of course, that's why it can play such a useful role in a portfolio, because when other things are doing badly because of those fears, gold will tend to do well. And, there have been sort of short-term reasons why the gold price has been going up. I mean, clearly, there's been a lot of uncertainty around the whole trade and tariffs situation during this first 100 days of the Trump presidency. But even before that, there were good reasons why investors were nervous about what was going on in the world. And in particular, since I mentioned 2022, and that's an important date because, a lot of gold's attractiveness to investors has come since the Russian invasion of Ukraine, and the importance of that was that the US froze Russia's dollar-denominated assets, and that made a lot of countries around the world, and in particular China, realize that they were very heavily exposed to the US in terms of their reserves, many of which were held in the form of US treasuries. And over the last 2.5 years, China has doubled the proportion of its reserves which are held in the form of gold. It used to have about 3.5% of its reserves in the form of gold. It's now about 7%. That's a very significant buying impetus in the
Is
gold market.
is that when you'll read this about central banks buying gold? Is that what is going on there?
Yeah.
Sort of strategic decisions being made at that level.
Yeah, it's a repositioning of central bank reserves to limit the potential risk in the future. China does not want the future of its reserves being controlled in Washington for good reason, and so that's why they're spreading their reserves more broadly, and gold has been a big beneficiary of that.
That equals demand for gold.
Yeah.
And the gold price going up. But it's come at a time actually when other conditions are less favourable for gold, I would have thought, because you've got interest rates higher in that time. That means the return on risk-free assets like cash rise. Gold is left behind in those circumstances. It doesn't do anything, doesn't produce that income, right?
Yeah, that's absolutely right. It shows the importance of the weight of money argument behind the movement in the gold price, because you're right to point out that there are other things going on which would normally argue for a weaker gold price. So you mentioned interest rates. I mean, one of the things about gold is it pays no income. So therefore, higher interest rates tend to be a headwind for gold, because if an investor can generate an attractive income from holding a fairly risk-free asset like a government bond, for example, then the incentive to hold gold, which doesn't pay an income, is diminished.
Yeah, and the other big claim that's often made about gold is that it's a hedge, a long-term hedge against inflation. Does the case for that really stack up? Because if you look over like very long, but not just decades, hundreds of years, as some people have, gold has actually held its value. There was people can read this sort of, I don't know if it's a sort of apocryphal thing, I don't know, but a gold in the Roman times an ounce of gold always used to buy, a high quality toga or something. And then the comparison today is, well, actually it will still buy you, a really high quality suit. I don't have any $3,000 suits, I have to say, but that almost works, doesn't it? Almost works as a kind of illustration of that way in which gold has held value against inflation.
Yes, I mean, I read something similar actually, which was that the salary of a centurion in the Roman
there you go,
army,
right.
2,000 years ago, expressed in gold, was actually not dissimilar to the salary of a captain in the U.S. Army.
Okay.
Now, so it's the same argument. So yeah, over the very long term, there is evidence that gold can act as a hedge against inflation. It's such a volatile asset that in the shorter term, sometimes it does and sometimes it doesn't. There isn't a direct link between rising inflation and a rising gold price.
No, and defined short term as well, because you can find data and charts that will show you that actually in inflation adjusted real terms, there's been decades when gold has lagged inflation and it would have lost value in real terms. It kind of depends where you want to slice your timeline.
Well, as ever with investments, the starting point is the crucial issue, and it's particularly the case with gold actually, because if you look at a long-term chart of the gold price, it tends to move in steps, so it can kind of go nowhere for years. And then in a relatively short space of time, it rockets. So I mean, in the 1970s, for example, I think the gold price rose 20-fold in between 1970 and 1980. At the beginning of this century, between 2000 and 2011, I think it rose 7-fold over that decade. So if you had caught it at the bottom of one of those rises, then your performance would look fantastic. But if you had if you'd bought
held it for 10 years before that.
Yeah, exactly.
Yeah. And actually, and I think you'd written this, Tom, that gold has got these landmarks of $3,000, $2,000, $1,000. It's often some big crises that pushes it above these big psychological barriers, isn't it? I think it was.
Yeah, that's right. So I mean, it went through $1,000 during the financial crisis. It went through $2,000 during the pandemic, and it's gone through $3,000 during the tariff issue, the trade war issue. So yeah, these big surges in the gold price do tend to be associated with moments of uncertainty and sometimes panic.
Yeah, and just before we move on to sort of some of the reasons why people don't hold gold, just another kind of current issue around this, which is to do with currencies and the weak dollar that we've seen, all tied up with similar issues around tariffs and trade. Gold is priced in dollars, of course. So the logic of this would be presumably that when the currency weakens, gold becomes cheaper for foreign buyers, potentially raising the demand, and the price would rise. That's helped gold recently, right?
Yes, I mean the dollar has fallen by about 10% over that 100 days that we've been talking about. So there has been a significant weakening of the dollar, and that has been a positive for the gold price for the reasons that you mentioned. If you're a buyer of gold and your home currency is sterling or the euro or the Chinese yuan, then a weaker dollar, on the face of it, gives you more gold for your money. Interestingly, though, when the dollar was going the other way, it didn't prevent the gold price from rising. So again, it's not a direct link correlation.
Yes. Okay, then let's go back to Warren Buffett then, shall we? And why a lot of investors will simply never hold gold. First of all, is that completely true of Buffett? No. And why might he say that?
Yeah, I mean, it's broadly speaking correct. I mean, he did briefly hold a gold mining stock. I think it was Barrick Gold. I'm not completely sure about that, but during the pandemic, and he didn't hold it for very long. He held it for about 6 months, and he did very well out of it because Warren Buffett tends to do very well out of these tactical. I mean, he has a reputation for being a long-term investor, but actually he can be very, very tactical. And clearly, during the pandemic, there was a flight to safe havens, and gold did well, and the gold miners did well. But broadly speaking, he hasn't held any gold apart from that.
And what is his case for saying that? Why does the world's most renowned investor not want to invest in gold?
Well, I mean, you hinted at it in that first quote. I mean, it does nothing. I mean, he says, gold will sit there and just look back at you and do nothing. He prefers his modus operandi when it comes to investments is to invest in the productive capability of the US economy, making things and
he believes in that at a country level and almost at a person level, doesn't he? He sort of really puts a lot of emphasis on people being able to generate value and be productive and make things and
So what he's saying about gold is that essentially the only way to make money out of gold is if someone wants to pay you more in the future than you paid for it. So in other words, because he associates it with fear correctly, if people get more fearful over time, then possibly the value of gold will go up, or rather, maybe not. He wouldn't put it in terms of value, but the price that someone will pay you for your gold will go up over time. But it's nothing to do with the creating anything. It's nothing to do with the growth of the economy.
Yeah, and I've got another quote, Tom. It's a bit of a long one, but I think it illustrates a lot of these points. This is also from Buffett. He says, I will say this about gold. If you took all the gold in the world, it would roughly make a cube 67 feet on each side. Now, for that same cube of gold, it would be worth today at around $7 trillion. That's probably about a third of the value of all the stocks in the United States. For $7 trillion, you could have all the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money as well. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, and me touching it and fondling it occasionally, call me crazy, but I'll take the farmland, I'll take the Exxon Mobils. And I guess what he's getting at there, Tom, is that it's not just gold's lack of productivity. It is that, but it's the opportunity cost, isn't it, that obviously offends him. He doesn't want to be buying this thing that he sees as just static lump. He wants to use it to invest in things that have the chance to grow and produce.
Yeah. I mean, what I love about that quote is it's classic Buffett, that he just creates something so sort of resonant and
Vivid,
evocative
yeah.
out of that. I mean, I've heard the same description of all the gold that's ever been mined in the world would fit in an Olympic-sized swimming pool.
Yeah.
But he's right that the equivalent value of it is what do you say? All the farmland plus 7 Exxon Mobils, and you'd still have $1 trillion of cash
Yeah.
left over. And well, of course, you'd rather have that than all the gold,
Yeah,
because the potential for that to create value for years and decades to come, which is what he essentially tries to do with his investments, is very significant. Whereas that lump of gold will be a lump of gold.
and it probably says something about how kind of sort of flighty I am as an investor. I followed that advice. I mostly do follow that advice. I don't normally hold gold, but I have actually at times held it. Probably because we've been through a period just as we have been, and I suddenly think,
it's been going
nice.
up.
Yeah, exactly. I just wonder, from your point of view, do you see the sense in it? Are you Buffett like in your attitude to gold?
Well, my instincts are with Buffett, but I also I do hold a little bit of gold in my personal portfolio for the balance that it provides, the insurance against, if just the feeling that if things really do go badly wrong, then
there's something softening the blow.
Solid there that will stick around and maintain its value. So it's a very small part of my portfolio, and I think it probably should be a small part of most people's portfolios. But I think there is an argument for holding it.
And that role you cut out for it there, it's almost like it's never gonna. Some people really believe in gold as I guess they're actually speculating on those big upswings. That's what they want to happen. But for most people, if you take on board that you can't really predict those, it's there, as you say, to kind of really soften other losses, really, rather than adding much in its own right. And if you're happy with that, and that's a perfectly respectable trade-off to make, isn't it? Big heavy falls are horrible to experience. And if you can lessen that, then maybe you'll give up a little bit of the upside when those growth assets are doing well and gold really isn't in fashion.
Yeah, and I'll give you one more reason to hold gold, which is that increasingly what we're seeing is that bonds and equities have become more correlated. So they move together more than they have done for quite a few years. So therefore, bonds are providing less of that balance in a portfolio than they did before. And gold does move differently from shares. So actually, I would say gold is not so much a hedge against equity underperformance. It's actually a hedge against the balance that bonds used to provide and maybe no longer provide.
Okay. Before we go today then, Tom, let's just spend some time on if you do want to buy gold, how you should do it. There's a couple of different ways for investors to do it. Actually, let's just address the physical, actually buying physical gold, because I was looking at this issue this week, and there are lots of people out there who are what they call stackers, buying actual lumps of gold and silver and keeping them and storing them or burying them in the garden. I don't know. Probably not it's not how most investors will do it.
No, but you can sort of see why they do it, because if you're buying gold as an insurance policy against the balloon going up and things really going bad, then actually holding the physical gold in a hole in your back garden is probably the logical conclusion of that baked beans and Kalashnikov's approach to life. So I understand why people want to do that, but the reality is that the cost of holding gold, the insurance, etc.
If you even do that, I mean, otherwise you're taking all sorts of. I mean, a lot of this content's out there. I mean, you don't want to laugh, but people doing that, and there's all sorts of stories about. They're so rife for rip-offs. The people buying and selling and trading in that world. A lot of incentive to pull a fast one, frankly, and and the world of financial instruments and markets is not perfect, but you probably have more assurance that there's greater scrutiny, greater regulation.
Yeah. I mean, safe to say it's not how I hold gold.
So let's get on to these.
So the other two ways, broadly speaking, you can do it through a financial instrument. You mentioned there, so the easy way to do it is through an exchange traded instrument, which simply tracks the gold price, and that's a sensible way of doing it.
Often backed by physical gold
Yeah.
in a vault somewhere.
Yeah.
But it's a traded. It trades like a share on a stock market, doesn't it? And it goes up and down with the gold price.
Yeah, exactly. But and crucially, it is backed by physical gold. So it's a way of owning physical gold. The other way of doing it is to invest in the gold mining stocks, which move slightly differently from the gold price. I mean, there are times when the two don't move in parallel. In theory, a rise in the gold price is extra good for the miner of gold, because their costs are relatively fixed, and so if the gold price goes up, then the amount of extra value that they create is proportionately greater than just the rise in the gold price.
Yeah,
that's the theory. We've covered this before.
We've covered it before.
The reality is it doesn't always work that way.
Because gold mining companies are, at the end of the day, company equities listed on the stock exchange.
Yeah,
they can be kind of moved with the tide of a stock exchange as well
there's
as
that,
with the gold
but
price.
they also have costs, and the costs of mining gold go up and down with the cost of other commodities like the oil price, for example, and wages. So they're not exactly parallel.
When you look at the long-term performance of the two things side by side, the gold price, as reflected through an ETF or an ETC, I think technically it would be, is actually more stable. I mean, gold can be a volatile asset, but that's more stable than the gold mining shares. Although the trend line is similar, often there'll be periods where those miners sort of surge ahead. That's what's happened this year, actually. But at other times they've underperformed. So it kind of depends what you want, doesn't it, out of your gold holding. If it's that hedge, does that lead you to a exchange traded fund or similar rather than the mining shares?
Well, I think if what you're interested in is that hedge, then the purest way of doing it is through an ETF. Now, as with everything in investment, because I don't know the answer, I do both.
Yeah.
I mean, I have as I say, my gold exposure is a relatively small part, but I divide even that small exposure to gold in two. I've got an ETF. I've also got a fund which invests in gold miners.
Okay, fantastic. Well, that just about covers it for now. Before we go, I will urge viewers, if you have found this useful or interesting, please do hit the like button and maybe even subscribe to the channel. It's going to help a lot more people find these videos. That said, that is it for now. Tom, thanks for joining me.
Thanks, Ed.